I thought in order to see what's out on the horizon for platforms, it was worth looking at history a bit and taking a look at how we got here. My own perspective, I was one of the first 3 employees at Norwich Navigator back in 1990, and we built that platform from the ground up. Followed that with co-founding the Avantios platform, now called Colonial First Wrap. And again, built that one from the ground up, and then I've been a driver behind Hub with the core team there. So 3 platforms I've seen go from 0 to their first BM, which is always the hardest, and on to 5, or we're now 6. And those other 2 went through 20, and Hub will do exactly the same. So it just gives me a unique perspective to talk about the future of platforms and where we've come from. So it isn't a case that platforms, if you build it, they will come. You know, adoption is driven by certain triggers, and I think managed accounts is a really good example. Toby, earlier on you mentioned that in 2002 you had a solution, but it wasn't taken up straight away, and now we've got this incredible adoption of managed accounts. So you need a whole lot of factors to drive that adoption, and I want to go through some of those factors that I think drove us to where we are today and look at some of those that are going to drive us in the future. But I think it's important to go back and look at what was the need, like why do platforms exist at all? And the way we like to look at it at Hub is platforms are really good at connecting investors, their advisors, whether they're brokers, financial planners, or stockbrokers, and connecting those with investment professionals, so asset consultants and investment managers. From the first days, that's really what we were trying to achieve, but the core reason was about delivering intellectual property of investment managers to the client. And I think we forget about that quite a bit. If we can deliver that intellectual property efficiently and the most cost effectively, we've got a good product. It's been done for decades though, delivering that intellectual property, and managed funds was the solution. So I think in 1924, the first open-ended managed fund, a modern day managed fund, was created in Massachusetts. And so that stood the test of time, 100 years of delivering at a mass scale the IP of fund managers to the client. And they're still doing it pretty well today. And I think for some asset classes, they'll continue to do it for a very long time. But we'll get into the managed accounts piece in a sec. And so why did platforms come along? Advisors, there was a proliferation of managed funds back in the late 80s, lots of different sectors, lots of different investment managers, and advisors at the time selling those, doing the right thing, diversifying their clients, mitigating risk, and selecting a number of those managed funds. That diversification meant lots of paperwork, really inefficient to manage, and master funds or master trusts at the time were the solution. So I know, John from Macquarie, you're saying, wherever you are, it was in 2000s that platforms came about. Well, I'm showing my age here, but you know, we launched Navigator in 1990. Asgard beat us to the punch, I think, in 89. They had a super solution out. And they were pretty good products, actually, in their day for the technology that was available. Remember, this is pre-internet. Just getting a portfolio valuation, if you want to do that for every client every month, it was nigh on impossible. You had to ring around and get valuations and find out what the client actually owned. Very tough. So master trust, single product, one application form, menu of managed funds, and provided consolidated reporting. The reporting was still manual. We're still mailing out stuff, and everything was over the phone, but they worked. And advisors liked them. They suited a need, and it drove, in my view, a repositioning of the advice industry. We went from an industry where it was really selling product to being able to service clients. And without a solution like this, that servicing wasn't possible. They enabled the movement from initial upfront commissions to an ongoing advice service model. So it really did change the industry. By mid that decade, the government came out with some regulations. I'm trying to remember, I think it was 93, 94. And personal superannuation, as we know it today, replaced approved deposit funds, and allocated pensions came in. So I remember that month in 1994, I think it was, when Navigator took $100 million for the first time in a month. And the players at that time were starting to hit $1 billion in FUA or more. So the superannuation side of the trust really delivered a solution to advisors to cover a much broader need of their clients, and they were taken up very quickly. So at this time, this was still cottage industry. The names at that time: Navigator, Asgard, FlexiPlan, AM Life, Connolly Temple. I can run through them all. There's some that don't exist anymore that, for a bad reason, like Excelsior, went out of business because they couldn't get the assets and the client data to match. It was still the cottage industry, but it was going strong, and there were still institutions standing on the sidelines. Some of them in particular were openly dismissive of master trusts and saying that they weren't going to continue. I think BT was obvious at that time in saying we will not put our products on your list. I think they capitulated in '94, Matt, you'll remember, and ultimately produced their own wrap later on. But at that time, the industry was relatively dismissive of these products, even though they were suiting an advisor need. So by the late 90s, lots of share ownership came in, CBA, Telstra floats, etc. Coles Myer discount cards were really popular at the time. And then the wraps came in. BT wrap followed by Macquarie. Massive step change in the industry. It really gave the industry that mainstream feel. Big marketing budgets, lots of adoption through those big budgets, and it absolutely changed the face of the industry. And you know, in some ways, people think the industry started then. Well, you know, we had this other 10-year period where it was going pretty well. But the other thing that happened at this time, or through this time, was the internet came along. So some groups were using it earlier on, but really in early 2000s, it really popped its head up. So we're talking, you know, the Entwistle wrap, it was literally built as an only internet solution. We only had that one front end. We had the same sort of issues with Pivot that Matt talked about before, where we were a totally internet-based solution, and we had to bring it back a bit to allow our advisors and clients to catch up. So we had to do more offline stuff to get adoption. We weren't getting the adoption we needed. And look, you can't underestimate that adoption piece. Our industry survives because advisors have conversations with clients and gain their trust to deliver us the FUA we put on the platform. Without those conversations, we don't exist. And so, you know, if we can build all this stuff and have this great technology, and geez, it's amazing what's coming, but at the end of the day, if those are conversations, we still really rely heavily on the client trusting the solution and being able to, you know, having enough trust to hand over their money. So I don't think we can lose sight of that. Anyway, with the internet came this incredible functionality that really embedded the platforms in the advisors' businesses, in my view. It would be very hard to go back from, you know, what the internet delivered: real-time reporting, the online capture of instructions, much less error rates, no double data entry. So it didn't all happen in the year 2000. I think Algorithmic launched in 2001. Some groups are still catching up today, would you believe? But obviously it had a massive change in the industry and drove adoption. Okay, my last one is managed accounts. So in terms of drivers for adoption of platforms in the last coming up on 30 years. So we're in a pretty good spot. And I should say, through that period in the 2000s, those names that I mentioned before, they largely disappeared from the landscape. Some of the brands still exist, but the players have gone. By 2010, the industry was largely dominated by institutions. And in my view, the platforms have become fairly homogenised. Either the institutions had built platforms, you know, BT is a good example, or they'd been bought. So Colonial bought Avantios, MLC bought Flexi and Navigator, you know, so, and ANZ bought Oasis. So, and once they bought them, you know, the weird thing was they didn't really invest in them in the way that I would think they should. But we'll come back to that. So managed accounts. As Toby mentioned, they've been around a long time. The concept has been running, you know, probably in brokerage houses in the States since the 70s. But for a whole bunch of reasons, they hadn't been taken up in Australia, even though there is a client benefit. And so that case, build it and they will come, it doesn't work. You know, and this is a great example. Some of the technology that underpins these managed accounts has been around for ages. But new technology did come through. But I think if we were to write the history of managed accounts in Australia, what actually drove it, it's a little bit embarrassing to say, but it was self-interest. The real trigger, in my view, was FOFA changed the way that dealers are remunerated, and that pushed a new revenue stream being required. So it's a little bit embarrassing for our industry. However, as soon as the gate opened and advisors were able to use them, the efficiency gains, it was an obvious outcome. We have had no advisors go back from using managed accounts. They love them as soon as they start using them. And the great thing is they're in the client's best interest. They really do work. So I think we are only at the start of this journey with managed accounts. Okay, so have they delivered? So looking at at platforms and where we are today. Does the investor have access to a wide range of investments and getting access to that IP? Absolutely they do, and an ever-widening amount of IP and investment solution. Is the experience better? No doubt, and a lot of that's been driven by probably the great functionality of the internet and mobile phones these days. Is that access efficient and improving? It is. We're investing as an industry, we're continuing to invest. There's some really large projects like Panorama going on, smaller groups like us and NetWealth that are really investing hard relatively. Is it cheaper? Well, it is, yes. When we launched Navigator in 1990, the super fund was 1.2% and all the funds on the list were retail, full retail. So the client was paying something like 3%. So it is far cheaper today, there's no doubt about it, and that's only going one way as we get scale and more efficiency. Have platforms made the advice businesses more efficient and scalable? No doubt about it. I think today you have much more efficiency in the way you can manage the clients, the implementation of portfolios, manage accounts delivering real benefits as well, and obviously more scale. And can they improve further? No doubt about it. There's been, if you look back that 27 years, incredible change in that time, including complete revolutions in technology. And I think what we saw in the last presentation, there's more coming. Enormous changes in technology coming that the platforms will adopt and improve further. So that checkpoint. Looking at our purpose. One thing I see fairly often, maybe not fairly often, but there are media articles questioning whether platforms are going to die. And it just seems completely ridiculous. Global industries are adopting platforms. Amazon's a platform. Seek, Domain, all of these groups are connecting buyers and sellers in some form in our industry. They are the dominant force. I think the only caveat to that is that if you don't invest in a platform, it dies. And we've got a few examples of that in our industry. It would be ridiculous if Amazon came out tomorrow and said, you know what, we're just going to close shop on the development house and we're just going to go with what we've got and we're just going to squeeze it for 10 years. They'll do okay, but ultimately they will create a gap within which new players, new disruptors will come through and fill the need, and they will keep investing. And so platforms that don't invest, they die. So where next? So we've got, I've got five more evolutions, if you like, in the platform industry coming. But there's some I'm not mentioning, and a couple that I just would like to mention that I think are just incremental improvements is the ever-expanding list of investments, things like international securities being added to platforms. It's only on a few of us now. I think the industry will adopt that as a standard going forward. Things like bonds and other assets. That list will ever widen. Will it improve adoption a little bit? But I think it's the thing that's going to really revolutionise things. And I think the other thing that's coming is innovative retirement income streams, and long overdue. So hopefully the government passes some new regs pretty soon. But I think that will have changed the way we service clients in a really good way, but not going to be an evolutionary change. So in terms of evolutionary change, my first one is managed accounts. And you're going to go, hang on, we've already covered that one, right? That was in the past. And yes, it was, but I think we literally haven't seen anything yet. The parallel I draw is looking at platforms or master funds in the late 90s, when just before BT and Macquarie were about to enter. And we've been on that 10-year journey, we've done pretty well, and then the big guys came in. And that's sort of where we are today, right? So there's groups like us and Praemium, been around a while. Probably 10 years we've been punching away in some form. And then the big guys are coming. So I literally feel we're at that point where it's just about to explode. It's going mainstream, and it's going to be enormous. It begs the question, will the same thing occur? Will the small guys like us, the independents, will they be taken out by the bigger guys over the next decade as we run through? And I think there's really good reasons why that won't happen this time. I was part of that revolution. Last time I helped sell my business to CommBank. So I've been through that process. My view is that there's a few reasons why it's just not going to happen this time. One is the banks aren't keen on wealth at the moment. They were really keen on wealth back then, not so keen today. They're more likely to exit than actually enter the space. I think the second is the startup environment. It was really, really hard getting funding and getting up and running 15 years ago. Today, it's a different environment. Startups are a natural part of our business culture now. We respect entrepreneurs. We give them money. We give them capital, and the market's open to them. And most of the players these days, the little guys like us and net wealth, and not so little, we are listed. We've got access to capital, so we don't need the institutions for capital or distribution. We're doing pretty well. I think the other thing is our technology is ever deeper and more complex. Institutions in buying businesses like ours have never been that good at retaining the real core IP and of the tech teams. So it presents a big risk, and I think it's just so deep, the technology now, the risk is even greater. And finally, I think that the new look players like ourselves, we probably look or have more in common with Facebook than we do with ANZ. You know, we're a pretty thin layer of financial services on top of a tech company. And so I'm not sure culturally the fit's there. So that's why I don't think it will mirror that era. But managed accounts themselves will really push on. So the two themes that I think are really going to push are automated personalisation. So this is where we can structure the algorithm to take the client's preferences and circumstances into account whenever we're doing the rebalance. We do a bit of this today, a lot of groups do a bit of it today. It's going to go a lot further. And if we can get this right, it will deliver the client an absolutely customised, better outcome. And if that's the case, it's going to be in the best interest to use these for the client. You can't justify using a solution that doesn't do this. So it will absolutely fulfil the client's best interest test. The other big theme that I'm seeing is the explosion of the algorithmic models. And by this, I mean really an extension of what's happened in the passive investment space. ETFs are just algorithmic-driven models. They're really basic ones. Most of them work on market cap or whatever their algorithm is. But there's so many more out there: factors, tilts, smart beta, etc. And AI is coming. S&P run 1.2 million indexes every single day. MSCI run 300,000, I think, at last count. And I think we'll see an explosion of those. And think of that, that's where those guys are today, and we don't have the AI ones yet. And I think there'll be so many more models. And we'll need AI engines to determine which models are the good ones. So it's going to be an incredible explosion of those algorithmic models. And what does that mean? That means probably a loss of jobs in the wealth management industry, in the active wealth management industry. So I saw the head of CFA was out here a few weeks ago predicting 10 to 30% of the US's security traders, analysts and portfolio managers won't be needed in the next 12 years, so through to 2030. That's a lot of jobs. That's something like 500,000 jobs. So, I think I was in the US a few weeks ago. The big passive investment there is massive. A number of advisors said to me, we've had 20 years of passive outperformance of the average active. So in my client's best interest, I have to choose passive. So that theme came through very strongly. And I think as those engines get better, those algorithms get better, and AI is a layer added on top of it, they'll be unstoppable and they'll be implemented through managed accounts. All right, the disruptors. So disruption's already underway in our industry. You may already know this, but between net wealth, us and premium, about 33% of the platform net inflows come to the three of us, and we represent about 3% of the industry. I think we're just starting. So this is a big trend, right? And we don't get to play in the space of the bank distribution, owned or aligned. We just get to play in the independent space, and yet these are the numbers of the entire industry, not just the wrap industry, the entire platform industry. It's about 700 or 800 billion. So that's a big deal. I don't think many people are aware. If you've seen our share prices, you know why. This is what's going on. And there's a good reason for this. We are so focused on delivering an outcome. The only priority we have is how can we make our advisors' lives easier? How can we make their client experience better? If we can do that, we get more adoption. We get more FUA. We don't have term deposits, insurance, managed funds, etc. to sell. That's our only priority. The institutions are a bit conflicted in that way, and sorry for all the institutions in here. But we have to keep pushing like that, because the reality is there are new players on the horizon as well. And Matt, you stole my thunder. Same quote. But yeah, Mike Cannon-Brookes, founder of Atlassian, in a conference a couple of weeks ago, said that the question is, are software companies going to figure out how to move into industries faster than the industries figure out how to be software companies. So if we rest on our laurels, if we protect margin, if we don't build the things that we could to make your life easier, other players will come in and fill the gap. So that's what we have to do. I feel this fear. This is a fear that drives a lot of what we do, because over that horizon, there's some really big groups looking at what we're doing. And just on that, this is not a typo. Alibaba launched a fund 4 years ago. Just a basic managed fund, money market fund. 370 million investors, 221 billion. So an average of less than $1,000 US per investor. I think they did about 100 billion in the first 12 months, so they slowed down. They must be pretty embarrassed about it now. It's incredible, right? It's an incredible number. And if you saw the latest 11/11 shopping day in China and some of the stats out of that, the volumes that they're creating over there are just bizarre, amazing. And there's no reason, like your Facebooks and Amazons and everyone else must be looking at this going, how do we do it? A lot of our media talks about, and I think the line from the banks is, they're not going to want to enter the space in Australia, it's too heavily regulated, etc. Yeah, probably they won't become a full, all singing, all dancing bank, but they're going to figure out ways to just chip away at certain segments and get incredible results. I don't know what that fund charges, but if it's 10 basis points, that's $221 million of revenue. So, just amazing. Robo-advice, do I get a ding for the term? Predicted to be 7 trillion by 2025. I also think this is a bit of a disappointment, but it's going to get a big, it's coming from something like 100, 200 billion today. And it's being pushed by the big institutions selling their services through robo-advice. Far less compliance hassle, all the planning scandals we've had within the banks, they don't become an issue with the robo-advice, it's automated compliance. And there's simple solutions. I also don't think that this is a big risk for you guys. I don't think, it was one of those build it and they will come. I must have had 30 robo-advisors in my door in the last 3 years. Almost none of them have gone anywhere. Because they built them, but no one really came. No one really understood the value proposition, or it was actually quite low-level compliance. I think there is a huge opportunity though, and the opportunity is the DIY market. They're going to go for those Alibaba funds, and good luck to them. Your current market, advisors' current market, is the delegators. High net worth people don't want to know about it. I'm just going to pay you a fee, and you'll figure it out for me. That's our current market. But the guys in the middle, I think every survey that comes out says that there's this big group of people who want more advice. They don't know how to get it, and often they don't think they can afford it. And the challenge, I think, is for our industry is that there's a generational change going on, and I think we've got less advisors in 5 years than we have today. So how do you service more clients with less advisors? And I think platforms will play a very big role in this. We will deliver the technology or the links to technology that will allow you to service those validators really well. And by validators, I mean the people who are pretty much happy to do it themselves, but want to check in every now and then to find out how it's going. Make sure they're on the right path, make sure they made the right choice. It's just run it by you at times. And they'll choose where on the spectrum they are. They might move up to delegation if they get really rich and don't care anymore. Might go back to being a full DIY at times. But I think our industry's been really segregated between the client either does it themselves through CommSec, or the advisor is a gatekeeper and doesn't let the client service anything themselves. And this group in the middle is, I think, the massive opportunity as an industry that we've got. I don't see big risk for really good advice practices in the delegator side. You might lose the odd client, but I think there's still a real need for clients who just want to delegate and feel comfortable and like the relationship you've got with them and feel like they're getting that strategic, almost life coach advice. I don't see a big risk to that. These validators in the middle, it's going to be really interesting to see how the industry responds and delivers a solution to service those affordably. Integration, I think this has come up a few times today. So we are big believers in open architecture. I'm glad the whole industry is aligned. It sounds like we're all going to be talking to each other. And what does that mean? So, platforms typically have talked about open architecture investment, but we're talking open architecture technology. It really does mean that we're going to take away the the barriers to entry of the platform and allow you to choose the best of breed apps that you want to use. We're also going to we'll move from just being safe custodians of assets and be safe custodians of data. I think that's a big role platforms will play. Matt, nice to see your cool thing coming in a couple of weeks. I'll be really keen to see it. So Hub's sitting on around $300 billion of portfolio data. We've got a sister company called Agility that is really a data company. And so our devious plan is to be safe custodian of that data for clients. About 170 brokers use that service. And be able to deliver true consolidated reporting across the client, whatever the client owns, through to the client. And you'll see a lot of the platforms are on that same path. We can't all get there, but the ones that focus on it, I think, will do a pretty good job. And what that allows you to do is to design your own platform. So you've heard this before today. You can create an ecosystem of your favourite platform, your favourite CRM, your favourite reporting tool, your favourite rebalancing tool, and bring them all together. It won't work. There was a question before about, how are advisors who don't have a CTO, was that you, Toby? How are they going to do this? It won't work if, as an industry, we say to the advisors, you figure it out. It will only work if the platforms get proactive about this and link these parties all together. And I think, as I said before, platforms becoming a safe repository of data. If we've got that position in the industry, it will be on us to make sure that it works seamlessly with all the parties that we have to get the data to and from. Finally, AI. So I had a whole spiel about this stuff, but I think my thunder's been stolen, and Dee knows much more about it than I do. But the reality is, this is going to change not just our industry, it's going to change your life. There's so many stories about AI going around. One of my favourite ones is the chat bots, as we've all heard about, but the chat up bots. So dating sites are being used, AI technology is being tested on dating sites where they're getting dates, human dates, from people purely via a chatbot. So now that either says something about the technology or the people on those sites, I'm not sure. But so many stories about how this is going, and it's going so quickly. So not that long ago, GM came out, an executive at GM came out saying self-driving cars, not going to happen in my lifetime. And announced last week it's coming out in 2019. They're going to have a fleet of cars on the road, self-driving electric cars. So it's coming far faster than we think. And the technology will literally change every part of the value chain. So I mentioned before the CFA prediction, that many jobs are leaving the industry. But having said that, I think that while it affects every part of the value chain, I still don't think it affects that true personal advice part. It's very hard to replace that. What goes into delivering the advice and implementing strategies, etc., will completely change. But that interaction with the client, I don't see that changing, that true, that delegated client. I don't see that changing anytime soon. So I think this is a huge opportunity. AI will mean that there's so much efficiency delivered, new ways of looking at things, hopefully much better investment solutions that the technologies are so good we never even thought about. And I think the key point here is that it's not man versus machine here. It's man with machine versus man without. You are so much more powerful with the technology behind you. And the AI that's going to be delivered will make platforms more efficient, will allow us to find things in the data that we didn't expect and share that data with you and help you run your business with it. We talked about the investment side, and I think robo-advice, for instance, I think AI will play a big part there. It hasn't to date, but I think it will. It'll take a bit of time. Financial planning strategies are really complex. I think AI is going to struggle with that for a period of time. But when it does, it means that, we saw SOA generation today taking less time, but I think the true strategy process underneath will really gear up. Okay, so I think we've covered all of those, and I'll move on to what does it mean for you? I think platforms, especially in our independent space, it's beholden on us to support advisors who are moving out of aligned advice to being self-licensed or with an independent. Stats out today from Bell Potter are saying that more advisors have left institutions again in their industry. It's a strong trend that's going on. It was in the US as well, Arnie said. And so I think we have platforms will have to play a role in helping you to be self-licensed, to be a boutique, and the challenges that you'll face in that. It will enable the platform developments that are coming, enabling the servicing of many more clients affordably. As I said, there's a big opportunity out there. We've got to find a way to deliver the services and the engagement tools to help you service those clients and actually gather those clients. The experience will improve. That's been a continuum since 1990. Used to be phone up, paper. Now it's all mostly mobile based. Even my mum looks up her portfolio on her mobile phone now. She's never seen a computer really. She's never used a web browser other than on her phone. She's got a phone now. I'm getting Instagram messages. It's incredible how things change. Servicing the digital nomads. So it will all be cloud-based, available anywhere, anytime. Most of it already is. We talked about that changing an open architecture that will change allow you to build within your own practice, your own ecosystem. Most practices I walk into these days have an app that I haven't heard of before. You know, it's something the 16-year-old son found and it was cheap or free and started using it, and it sort of had a specific task that it did pretty well. The challenge is none of that work is working together that well today, but that will change. And hopefully amazing investment solutions. So that was that core purpose of platforms from the start, if we remember. And I really think what's coming in terms of the technology that's going to drive different investment solutions is really going to be a step change for our industry and in a really positive way. And finally, collaborating with allied professionals. So platforms typically have been pretty binary, advisor and client. And I think there's a way that we can get allied professionals, be they accountants or brokers or whatever, to also service that client through the platform, connecting all of those parties together. There's a couple more things over the horizon. I could talk about blockchain for a second. I didn't put on my slides. And one of the reasons for that is I see it as over the horizon. I don't see it as sort of in the next few years. Blockchain is incredible technology. It's an incredible idea. It's so early that no one's really figured out, in my view, how to apply it to our industry yet. The ASX got a really cool initiative going on, but they still haven't really figured it out. It's very much a prototype. Will it change our industry though? Absolutely. Where? Probably things like safe custody. Safe custody probably doesn't exist in a blockchain environment. If you've got an irrefutable digital record, you don't need a global bank to hold it to make sure that that's the case. So I think some parts of our industry will be under real threat there. I think, again, at the front end, the advice end, I don't see much threat. I see huge opportunity in the benefits it delivers in terms of efficiency and cost. Anyway, overall, I think it's all of these changes at the end of the day will allow you to service your clients better, service more clients more cheaply, deliver a better overall result. So it's all good. Thanks very much.
We've definitely got time for questions. I think that was a fantastic presentation. I just want to kick it off. I've got a quick question. You talked about there isn't the appetite for businesses like yours.
Ender a bit closer to the. Yeah.
Is it working? There it is. You talked about there isn't probably an appetite for the big institutions now to come and acquire you and net wealth, etc. But will it be international firms or even technology firms that come and acquire you guys?
Look, it's possible. Matt's newly listed, so can everyone hear me? This is on? Yeah. Our chairman likes to tell us that we're for sale at 10 a.m. every morning as the market opens, and it's true. We can't control exactly what happens in that space. At the end of the day, there's a price that our shareholders will accept. But what I know from Hub shareholders is they've really enjoyed the journey from not much to $10, and they really believe that we can go multiples of that. And we've given them every indication in our success to date that we can do that. So I think that we're quite a unique beast. We don't look like a truly financial services company. We don't look like a true tech company. we're somewhere in the middle. And so I think people look at us and scratch their heads about where we fit. Having said that, there are groups out there that, if I wanted a beachhead in Australia, where there's a couple of obvious choices. But certainly there's been no indication of that to date.
Do we have any questions from the floor?
Well, I've got one if there's nobody else.
Stunned silence.
No, my question is about regulation and compliance. So, Jason, as you see the platforms evolving in this way and delivering these capabilities to advisors and, more to the point, to the licensees that they represent, do you see the regulator starting to establish benchmarks for around best interest and the ways, the capabilities that licensees ought to bring to bear on the advice process?
Not really. I think they'll, and what they've done to date is, have the vague reference to it's got to be in the client's best interest and let us figure it out. So, they'll test it in court at times. I don't think they'll set benchmarks. Regulators are really reluctant to do that kind of thing. Everyone wants lunch. All good.
Anyone else?
Thanks, Ryan.
Can you please thank Jason for his presentation?